One of the simplest ways to get started with investing to help grow your investments to millionaire status are index funds. In this video, I'm going to break down very simply what index funds are, the benefits and disadvantages, and we are going to do an on-screen walkthrough of what to look for in an index fund. Hey, what's up guys? It's Justine with Debt Free Millennials, the channel to help you crush your debt and live payment free. Now, part of my channel, we do a little bit of an investing series and we talk about what the heck to do in order to get started. And I have to tell you, index funds are my favorite types of investments to grow my retirement and grow my investing accounts. Now, before we get into the nitty gritty, I do want to let you know that I am not a certified financial planner, so please take this video for education only and really do your research when it comes to your money, because nobody else cares about your money more than you do. All right, so what are index funds? Index funds are a collection of stocks that track the performance of an index over time. Think of an index like the S&P 500. You're going to see that index perform, go up and down, and that index fund is going to more or less track the performance of that particular index. Now, I love this definition from Investopedia.com, and they say index funds seek to match the risk and return of the market based on the theory that in the long term, the market will outperform any single investment. Rather than trying to buy individual stocks, individual equities, you are going to diversify by putting a little bit of money into every single stock that is hosted on that particular index so that you can see how it performs over time. And remember, with an index, and we'll go back to the S&P 500 example, that's a list of the top 500 companies within that index. And that is naturally going to pick out the companies that are underperforming, that no longer can be part of that top 500 list, and they're going to keep the best 500. So you don't have to worry so much about whether or not you should sell that particular stock or hold on to that particular stock for a number of years. The index fund is pretty much going to do that work for you. Speaking of which, let's talk about the benefits of index funds. First, you're going to get broad exposure to the stock market because you are investing in every single company hosted on that index. Next, they are low cost. They are low cost funds because they are not actively managed. Because this is automatically done for you based upon what's going on inside of that index, you don't have to worry about any additional management fees. Also, index funds are ideal for long-term investing and retirement. It's a great hands-off approach for investors who really don't want to get into their accounts and worry about whether or not they should buy and sell, because all of that stuff is just automatically done for you with an index fund. So if you consider yourself a lazy investor, or you have no particular desire, time, or energy to put into your investments, index funds are a great option. All right, so let's talk about the disadvantages of index funds. First of all, they are not immune to stock market crashes. If the market dips, you're going to see those index funds dip as well. So it all goes back to that high risk, high reward mentality, much like you would see in stocks. And you can actually measure that risk level depending on what index funds you are looking at. And we'll get to that in a second when we do our on-screen recording. Remember too that there are still fees. So even though they are low cost fees, there's still going to be fees that you incur just by buying into these particular funds. Now, on average, these index funds are going to be 0.2% or less compared to actively managed funds, which typically have about a 1% fee associated with them. And lastly, you can't cherry pick your stocks. So if you're really interested in buying up a whole bunch of Tesla shares, or you're wanting to go all in on a company that just went public, public. You really can't do that through an index fund. You'd be better off picking those individual stocks outside of an index fund. All right, let's go ahead and hop into Vanguard.com. There are other platforms that you can definitely use to buy index funds, such as Fidelity, but I'm going to use Vanguard because that's where I have all of my index funds, and I'll show you what to look for. Let's go. All right, so I just logged into Vanguard, and they have this really cool tool where you can look at their various investment products, and then I am going to filter this by the management style, which would be index. So these are passively managed, more or less, and we are going to do, I think what we should do is let's compare a bunch of these, okay? So we'll look at the VFIAX 500 index fund, the Admiral shares. We'll look at long-term bond index fund institutional shares. Let's do total bond market index fund Admiral shares. This is the one I'm currently invested in. And we'll do VTTSX. It's a target retirement fund with a target retirement date of 2060. Those are what these target funds mean. And let's find one more. Okay, let's do this one. This is one of my favorites, the Total Stock Market Index Fund Admiral shares. All right, now let's compare. Okay, you can see the various index funds that I selected. Some of them are based upon the stocks that might be in a particular index. Other ones are tracking bond indices. So let's go down and kind of zoom in on this chart right here. So a couple of things that I look at before I actually go in and invest my money into these types of funds is I like to look at the risk level. They say risk potential here. So the higher the risk, the higher chance of reward. If you have time on your side, and if you're Gen Z or millennial, and even honestly Gen X too, we still have time on our side, and we are getting to those peak earning years in our careers. I would say this is a great time to explore some of these higher risk level funds. So we're looking at the Vanguard 500 index fund has a risk potential of 4, whereas compared to the long-term bond index and the total bond market index funds, you're going to see that risk level drop down to 2 and 3. And then the target retirement fund of 2060, so if you were planning on retiring in that year, you have a risk potential level of 4, and same with the Vanguard Total Stock Market Index Fund. So that's one of the things that you should look for when you are looking into these funds, which ones you want to buy into. What's your risk tolerance? The next thing that you'll want to look into are the expense ratios. Expense ratios mean how much fees am I going to pay in order to buy into this fund. Now, here are the expense ratios for the particular funds that I selected. All of them are super low. And I told you before that actively managed funds typically will slap a 1% fee or higher on those expense ratios and on those actively managed funds. So compare this with mutual funds, you're getting a very good deal because these are such low cost. The Vanguard 500 index fund, total stock market, the total bond market, and long-term bond index are all 0.04% or 0.05%. The highest expense ratio here would be the target retirement index fund, and I think that's probably because there is a date associated with that fund. So as you get closer to the year 2060, that index fund is going to reallocate those funds so that it shifts more of the risk level into lower risk funds such as bonds versus stocks. So right now you're going to see the risk level a little bit higher because we still have time on our side. We have like 38 years until we hit 2060. So you're going to see that fund go more stocks, less bonds, and it's going to shift over time to make sure that they make the most out of the money in that investment to hit that target date. So those are the target retirement funds. Also, another thing that you'll want to look at, let's go down here, is obviously we want to see what the performance or the rate of return of these particular funds are. So we are going to look look at not 1 year, not 3 year, not 5 year, maybe 10 year, but what I like to focus in on is the rate of return since inception. Since inception means since the fund started, since it was created. I also like to look at the creation date to see how long this fund has actually been going for. So look at the Vanguard 500 index fund here. This fund was created back in 2000. So over 20 years ago, this fund was created, and since inception, it has averaged a 7.87% return. Now you're going to see within the last 10 years that the rate of return has actually been almost double that, 14.6%. But again, index funds are meant to be long-term investment vehicles. And if we're trying to hit millionaire status, if we are really wanting to use this money to work well for us in our older years, you're gonna wanna look at this inception date here. Now, the long-term bond index fund, I'm really surprised to see it's so high, 6%. That's really good. So if you were to keep your money inside of a long-term bond index fund, you're not gonna like what it's done in the past year to date. In fact, year to date, all of the funds have been down. And over the past 1 year, it's been kind of a wild ride. If you were in the Vanguard 500 index fund or the total stock market index fund, you'd say, oh yeah, in the last year, it's done really well. If you were in these bond index funds like I've been for building up a down payment through a brokerage account, past year has kind of sucked, to be honest. But if you want to keep that in here between the 3 to 5 year range, it's not too bad, right? It's actually doing a lot better than money that might be parked in a savings account. So you're going to earn a lot more interest in that regard. But again, if you are looking for long-term investing options, you're going to look at this inception date. And this target retirement fund of 2060 actually looks really good. Since inception, it's earned 10.69% as a rate of return. And I actually have a ton of money in the Vanguard Total Stock Market Index Fund, and that has a 8.22% rate of return. We're gonna hop down to the fees and minimums comparison chart, because something specific to Vanguard index funds is there's typically an account minimum to invest into these types of funds. Now you're going to see if you wanted to invest in the Vanguard Total Stock Market Index Fund, and these are the Admiral shares for both, you're going to have a minimum of $3,000 in order to invest in those funds. Now you can use ETFs, exchange traded funds, that are basically the same thing as this without incurring that minimum, without needing to hit that minimum. The only thing with ETFs on the Vanguard side of things is that you cannot do automatic contributions into those ETFs, and you are also going to buy at the price point that it is that day. So rather than being able to play averages and just do it very simply through the Admiral shares, there's just a little bit more manual work with the ETFs. But a recommendation that I have for you, or a suggestion, would be to start with the ETFs if you don't have that 3K minimum for the Admiral shares. And then once you do have enough, then you can sell the ETFs and then buy into the Admiral shares version of that same fund. Again, I'm not a financial advisor, but if I was to do this without being able to buy in at that 3K minimum, that's what I would do. Another thing that you can take a look at are the largest holdings of that particular fund. And you're going to see some big company names listed here: Apple, Microsoft, Alphabet, Amazon, Tesla, Berkshire Hathaway. I mean, there are so many companies in here that you know that you probably buy from that are already inside of this index fund. Imagine being able to be a fractional owner of Apple, Microsoft, and Google just by using and buying one index fund. I think that's pretty cool. Okay, so now that you know what index funds are, the benefits, disadvantages of them, and you know how to look and research for the right index fund for you online, go fly away, young investor, and come back to me and comment below on which index funds you have found. They don't have to be Vanguard. I would love to know what other index funds that you find out there, such as the ones with Fidelity, that you could tell me below that have hit the criteria that you are looking for. If you thought this video was helpful in your investing journey, please consider giving this a thumbs up and subscribing to the Debt Free Millennials channel, and I'll catch you in the next one.